Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 1, we covered the basics of SPACs. Now, let's dive deeper into how to evaluate SPAC opportunities, what red flags to watch out for, and tips to protect your money. Ways to mitigate these risks. Research the SPAC sponsors. Experience matters more than promises. Wait until a merger target is announced before investing. Scrutinize the target's financials like you would for any stock. The bottom line? SPACs aren't for passive investors. They require digging, skepticism, and patience. Three things the market sometimes forgets when excitement takes over. How to evaluate a SPAC investment. Knowing how to assess a SPAC separates smart investors from those just chasing hype. The best SPACs have strong leadership and promising targets, but spotting them takes work. Here's where to focus your research. Assessing the sponsors. A SPAC is only as good as the team behind it. Sponsors are the architects of the deal, and their past performance tells you what to expect. Start by digging into their track record. Experience. Look for sponsors who've successfully closed SPAC mergers before. First-timers are riskier, even if they have big names attached. Industry expertise. Teams with deep ties to their target sector often find better deals. A tech-focused SPAC led by software veterans? That's a good sign. Skin in the game. Sponsors who invest their own money align with shareholders. If they're only in it for the promote shares, tread carefully. Watch for red flags like a history of overpromising or targeting unrelated industries. If their last SPAC merged with a struggling company, ask why this one will be different. Understanding the target. Once a SPAC announces a merger target, the real homework begins. Don't just rely on press releases. Check the fine print. Focus on these areas, industry trends. Is the target in a growing market or fading? Electric vehicles and AI have tailwinds. Fad-based businesses often crash. Financial health. Look for revenue growth, manageable debt, and clear paths to profitability. Avoid companies burning cash with no plan to stop. Valuation. Compare the deal price to similar public companies. If the SPAC pays a 50% premium for no clear reason, that's a warning. Ask yourself, would you buy this stock if it wasn't a SPAC? If not, walk away. The blank check structure shouldn't cloud your judgment. Pro tip: wait until the merger prospectus, S-4 filing, drops. It reveals far more than the initial announcement, including risks the SPAC downplays. A quick checklist for targets. Growing sector with long-term demand. Revenue, or a credible path to it. Realistic projections, not pie-in-the-sky forecasts. Competitive advantages versus rivals. Remember, SPACs trade on potential, but eventual profits rely on cold, hard facts. Treat them like any other investment, just with extra steps. The future of SPACs. SPACs have had a roller coaster few years, surging in popularity before facing skepticism as regulation tightened and some high-profile deals underperformed. But where do they go from here? The road ahead hinges on two big factors: evolving rules and where the smart money is flowing, regulatory changes and their impact. Regulators are paying closer attention to SPACs after years of loose oversight. New rules aim to protect investors, but they could also slow down the SPAC machine. Key changes to know. SEC reforms. The SEC now holds SPACs to stricter disclosure standards, treating them more like traditional IPOs. SPACs mergers must share detailed financial projections and risk factors up front. Liability risks. Sponsors can no longer rely on safe harbor protections for forward-looking statements. If their projections miss the mark, they could face lawsuits. Accounting rules. Recent guidance requires SPACs to classify warrants as liabilities rather than equity, complicating balance sheets and costing more to audit. These rules have already cooled the SPAC frenzy. Fewer SPACs launched in 2023 than during peak years, and some sponsors walked away from pending deals. But for serious players, this isn't necessarily bad. It weeds out the quick flip artists and leaves more room for credible mergers. Market trends and predictions. SPACs aren't disappearing, but they're evolving. Here's where the action is shifting. Hot sectors. Green energy. Climate tech startups favor SPACs for faster funding to scale projects like battery recycling or carbon capture. Biotech. Cash-hungry drug developers use SPACs to bypass the risky IPO window when markets are shaky. AI and defense tech. Companies with government contracts but limited public data often opt for SPAC mergers. Quieter deal-making. Gone are the days of celebrity SPACs chasing meme-worthy targets. Today's deals focus on smaller mergers, under $1 billion, with less hype. Targets that already have revenue, not just ideas. Sponsors with niche expertise, not just big names. SPACs won't reclaim their 2020, 2021 highs, but they've carved out a niche. For the right companies and the right investors, there's still a viable path to the public markets, just a much noisier one. SPACs offer a unique path for investors to tap into early-stage companies, but they're far from a guaranteed win. The best opportunities come with strong sponsors, clear targets, and realistic growth plans. Without these, the risks, dilution, weak due diligence, regulatory shifts, can quickly turn a promising bet into a dud. Keep one rule in mind: never invest blindly. Research the team, scrutinize the target, and weigh the numbers before jumping in. The market will keep changing, so stay updated on SEC rules and sector trends. Want to dive deeper? Track upcoming SPAC mergers or follow industry reports. The more you learn, the better your chances of spotting the real deals and avoiding the hype traps. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.